He didn't lose his money. His money is still in his account, in his bank, in his country. He just can't spend it outside Russia anymore, and he can't even receive anything from the outside world either. 4 days earlier, Russia had invaded Ukraine. The Western response was not bombs, not troops, not a naval blockade. It was a clear message sent to over 11,000 banks in 200 different countries. Russia is no longer part of the system. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, a Belgium cooperative founded in 1973. Most people have never heard of it. It is the single most powerful lever the Western world holds over any economy on earth. In the hours after the announcement, every government watching, everyone with a complicated relationship with Washington asked the same question. What happens when they do that to us? To understand what India truly built, you need to understand what it was built against. Here is how money actually moves between countries. When you send your money internationally, it doesn't travel directly from your bank to theirs. It hops through a chain of correspondent banks, each one processing the transaction in US dollars, each one sitting inside the SWIFT messaging network. Remove the SWIFT access, the message cannot be sent. Lose the dollar clearing, the chain breaks almost immediately. The money stops, not stolen, not destroyed, frozen in transit permanently. Iran 2012 cut from SWIFT. The rial lost 80% of its value within months. Oil exports halved. Not because Iran's oil stopped being oil, because the payment infrastructure to sell it ceased to function. Russia 2022, $300 billion in foreign currency reserves, frozen. Not confiscated, not destroyed, the money still exists. It is simply locked in a system whose owners have now decided that Russia no longer has the right to use it. The United States did not design this as a weapon. The dollar became the world's reserve currency after World War II because the United States of America was the only major economy left standing. SWIFT was built for efficiency, not Coiricon. Correspondent banking evolved organically over decades after this development. But infrastructure doesn't need to be designed as a weapon to become one. When every bank on earth needs access to your system to function, you don't need a law, you don't need a vote, you make a phone call. Every country that moves money through the American infrastructure is, whether it chose to be or not, is inside American jurisdiction. India actually understood this very early. It took us a very specific humiliation 30 years earlier to make it act. It goes back to a story. It happened at night. May 1991. Trucks moved after dark. A convoy from the Reserve Bank of India's vault to the Palam airport. The cargo carrying over 47 tons of gold bars. No press briefing, no parliamentary announcement, no public statement. Destination: the Bank of England. Collateral for an emergency loan India desperately needed because India had only 14 days of foreign exchange reserves left. 2 weeks until it couldn't pay for its imports. 2 weeks until the economy seized. A second shipment, 20 tons more, followed days later to the Union Bank of Switzerland. 67 tons of gold pledged to foreign banks in secret because there was no other option. The finance minister who signed off on the arrangement was a soft-spoken economist named Manmohan Singh. He later went on to state that it was one of the most humiliating moments in his professional life. Not because the gold was taken, it was eventually returned, but because India had arrived at a point where it had no leverage, no alternative, no exit. It was a debtor nation at a creditor's window, and it only had to accept whatever terms it was given. The IMF loan came with condition, liberalization, structural adjustment, the standard package. India complied. It had no other choice. Manmohan Singh liberalized India's economy through the 1990s with the same competence and quiet determination of someone who never wanted to be in that position again. He went on to become the Prime Minister of India in 2004, and the memory of those trucks moving in dark never left the institutions that he went on to shape. 17 years later, the world broke again. It's 2008. The global financial system collapsed under its weight of its own complexity. Banks failed, market froze, economies contracted, India slowed, but it did not break. When asked why India had held while others hadn't, why Indian banks were intact while Western ones were imploding, his answer was quiet. India had been conservative. Let me explain. Conservative means Indian banks had been required to hold more capital than Western regulators demanded. Conservative means India had maintained capital controls that Western economists spent years urging to abandon. Conservative means the financial plumbing was unglamorous, inefficient in places, and absolutely intact. 1991 taught India what dependency costs. 2008 thought what insulation is actually worth. The next system India would build would try to do both. The question was not whether to build alternatives, the question was how fast and how well. 2016, India demonetizes 86 of its currency overnight. The stated rationale: eliminate black money. The actual effect: chaos. Hospital turning away patients who couldn't pay in the new notes. Daily wage workers with no way to access their earnings. The informal economy, which is most of India's economy by the way, grinding to a halt. It was painful, poorly executed, politically controversial. Economists still argue about whether it actually worked. But it did one thing that nobody had managed to engineer through a normal policy. It actually forced more than 250 million Indians to download a payments app in just 18 months. The system they were downloading was called UPI, Unified Payments Interface, built not by a bank, not by a tech company, by the National Payments Corporation of India, a non-profit entity backed by the Government of India and the Reserve Bank. Not a product, they were building an infrastructure. Here is what makes UPI structurally different. Visa and Mastercard sit between your bank and a merchant, charging about 1.5% or upwards of 3% on every transaction, a tax on every purchase every single day, flowing to two American companies. SWIFT is a messaging layer for international transfers, requiring correspondent banks, dollar clearing, and multiple intermediaries. UPI actually connects two bank accounts directly, real time, any hour, any day, with zero transaction fees. No intermediary extracting rent, no foreign company in the chain, no infrastructure outside India's jurisdiction, no dependency on SWIFT, no dependency on dollar clearing, no dependency on America's goodwill. India had built a payment trail it owned completely. What it didn't know was what to actually do with it. Think about what it used to mean to somebody like Ramesh. No bank account because the nearest branch was 40 kilometers away and required paperwork he couldn't produce. No credit history because he had never borrowed from an institution that kept records. No way to receive digital payments because he had no card terminal, no merchant account, no credit score. He existed, he just didn't exist to the financial system. UPI is one piece of what changed that, but it didn't work alone. India actually went on to build a stack. Let me explain. See, at the base, it had something called as Aadhaar, a biometric identity number, fingerprint and iris issued to more than 1.4 billion people. Not a database in a government office, a live, verifiable portal identity that actually works on a basic phone even with a bar of signal. For the very first time, Ramesh could prove his existence to any institution, anywhere, almost instantly. On top of that, UPI, once you have an identity, you can have a bank account. Once you have a bank account, you can receive or send money real time for free. On top of that, DigiLocker. Every government document Ramesh has ever touched, birth certificate, land title, tax records stored digitally, retrievable instantly, legally verifiable without a photocopy or a trip to the government office. At the top, we've got account aggregators. With Ramesh's consent, his financial history, years of UPI transactions, tax filings, business cash flows could be shared with a lender. For the very first time, a vegetable seller in Patna has a credit profile. Most countries built their financial systems for people who already had money. The systems assumed a fixed address, a salary, a credit history, a bank account opened by your parents. India built one for people who had none of those things, and in doing so, without quite intending to build, it went on to build one of the most sophisticated public financial infrastructure on earth. 500 million people brought into the formal economy in under a decade. Not through aid, not through foreign investment, not through charity, through simple architecture. Here is what the system actually does today. In 2024, UPI processed over $2 trillion in transaction, 14 billion transactions every single month. Visa processes roughly $200 billion a day across all its global networks. What India had built on a government non-profit at zero transaction fee is now processing at a volume that would have been considered impossible for an emerging market just a decade ago. India accounts for nearly half of all real-time digital payments on earth. Not because Indians are uniquely tech-forward, because the infrastructure is better, more accessible, faster, cheaper than anything that the private sector built anywhere else, including the United States, where Venmo and Zelle still take days to fully settle and don't work at 2 a.m. on a Sunday. The system works comprehensively, and India has now started asking a different question. What else can we do with it? India's G20 presidency in 2023 had one quiet obsession running beneath every official agenda item: cross-border payments. Not debt relief, not green finance, not agricultural subsidies, payments. Because India's strategies understood something that most diplomats were still processing: the country that exports its payment trail exports its jurisdiction. Through UPI, it was exported and went on to work in 30 different countries. You can now land in Dubai, Singapore, France, or Fiji and pay directly from your Indian bank account. No card, no currency conversion, no visa fees, no dollar clearing. For tourists, that is actually very, very convenient. For India's foreign ministry, that is a different conversation altogether. Because India is not just allowing UPI to be used internationally, it is actively offering its architecture to developing nations as sovereign infrastructure. Not use our app, but take our blueprint, build your own version, run it on your own servers, and connect it to ours bilaterally. Sri Lanka has done it, Mauritius has done it, Nepal, Bhutan. They have not just adopted UPI, they have adopted India's financial stack, which means their domestic payment infrastructure now runs on the architecture India designed, India helped build, and India can help evolve. Infrastructure relationships used to require a military alliance or a colonial history. Britain built railways across its empires, and those railways helped shape trade routes, supply chains, and dependency patterns that outlasted the empire by decades. India is doing something structurally similar, without an army, without colonization, with a payment trail and a government non-profit. The logic is the same as it has always been: build what people need, make it work better than any other alternative, and just wait. Look at these three cases specifically. They tell you where this is actually going. His name is Bikram. He is 24 years old. He works construction in Delhi and sends money to his home in Pokhran every month. For most of his adult life, the transfer cost him between 6 to 8%. Traditional remittance channels, wire transfers, and informal networks. 6 million Nepali workers like Bikram send money from home from India annually. The fee burden on those transfers was running at about $400 million a year. Not $400 million going to Nepal, $400 million disappearing into correspondent banking fees before it actually arrived to the end user. Nepal went on to integrate UPI to its national payment system in 2023. Bikram's transfer now costs zero. That is $400 million a year that stays with Nepali families instead of vanishing to a transaction chain that absolutely nobody can actually see. And it is Nepal's financial infrastructure now running in a corridor that India has actually designed. UAE, 3.5 million Indians, the largest expat community in the Gulf, responsible for roughly 30% of consumer spending in certain retail categories. The UAE did not adopt UPI because India lobbied for it. It adopted UPI because 30% of your consumer market paying frictionlessly in a commercial advantage for UAE businesses. When your payment rail reaches that scale, adoption becomes the other country's business decision and not the country's business decision. France, G7 nation, founding EU member, now accepting UPI at most visited tourist sites. The significance is not the convenience, it is actually the signal. France, a country that helped design the European financial infrastructure, that co-created the euro, that has spent decades asserting monetary sovereignty against dollar dominance, it is now plugging into Indian payment infrastructure for purely practical commercial reasons. Three countries, three completely different reasons to adopt one direction of travel, and that particular direction is not slowing down. There is a country conspicuously absent from every official Indian government presentation of UPI's global expansion: China. China has been running a parallel play for a long time with more resources and with a completely different endgame. UnionPay, China's state-backed card network, is now accepting in more countries than American Express. Alipay and WeChat have been exported aggressively across Southeast Asia and Central Asia. CIPS, the cross-border interbank payment system, is China's explicit SWIFT alternative, designed to move money internationally without touching the American infrastructure. The Belt and Road Initiative is partly an infrastructure story. It is also substantially a payment infrastructure story. China built roads and ports across 140 different countries, and alongside them, financial plumbing that runs through Beijing. The difference between China's approach and India's is actually the structure. Let me explain. China is building a dollar replacement, right? It is internationalizing the currency that they have, which is yuan, pushing CIPS directly as a swift competitor, explicitly attempting to shift the reserve currency conversation. India is actually not trying to do that. India is building sovereign corridors that settle in local currencies bilaterally, rupees to dirhams, rupees to rupees, keeping the dollar out of the transaction, not by attacking it, but by not absolutely needing it. Two countries running parallel experiments in financial sovereignty. They don't cooperate, they don't coordinate, they share a contested border and decades of strategic rivalry, but both of them, for their own reasons, are building for the same exit door. And they both are surprisingly members of the BRIC, a bloc that in 2023 added 6 new members and opened a formal discussion about a settlement currency that bypasses the dollar entirely. That is not coincidence. Washington is actually comfortable with. When advisories independently converge on the same strategy, that strategy deserves to be taken seriously. Washington has actually noticed. In 2023, the US Trade Representative's annual report flagged India's payments policy as a market access barrier. The specific citation is UPI's zero fee structure is anti-competitive. Stripped of diplomatic language, the argument is this: American companies cannot compete with free. Visa and Mastercard have been lobbying against UPI expansion for years. Their India revenues are structurally threatened, not because UPI is a superior international payment system, but because UPI had made 1.4 billion people comfortable with a system those companies are simply not a part of and not ready to comply with, right? UPI's share of India's digital payments is now about 80%, and that, ladies and gentlemen, is absolutely mind-blowing. But the commercial concern is secondary. The strategic concern is this: India has demonstrated that the government can build payments on zero infrastructure at a sovereign scale at zero cost to its users and export it as a geopolitical architecture, right? Without a weapons program, without a military alliance, without a reserve currency, just mere infrastructure offered to willing countries on practical terms. The United States has used financial infrastructure as foreign policy since the Bretton Woods Agreement in 1944. The dollar's reserve status, the SWIFT networks, corresponding banking requirements, IMF lending conditions, all of them were actually built on just one single logic. If you want to access the global economy, you need to access it on the America's terms. UPI does not break that logic, not today, not even close, but it creates something different that did not exist before. An exit door, functional, growing, used by real countries for real transactions. And once an exit door actually exists, the leverage changes. Not because everyone walks through it, but because the threat of walking through it becomes real. That changes the negotiation once for all, even if the pieces never actually move. There is another version of the story, and the one that nobody wants to talk about, or the one that doesn't work. April 2024, UPI experienced a major outage. Millions of transactions failed across India within hours. Merchants couldn't accept payments. Employees couldn't receive wages. A country that had moved 80% of its digital payments onto a single rail discovered on one afternoon what the concentration cost is when the entire payment rail actually goes on to fail. The outrage actually lasted for several hours. In a country where UPI is no longer optional, several hours is a very long period of time. UPI is not decentralized. Multiple banks and apps actually run on top of it. But the core infrastructure operated by the National Payments Corporation of India is a centralized system. Centralized systems are efficient. They are also brittle in specific predictable ways. The cyber security risk is actually real and documented. India's financial infrastructure has been targeted of state-sponsored attacks. AIIMS Delhi, one of India's largest hospitals, was hit by a ransomware in 2022, taking its system offline for weeks. A targeted attack on NPCIs, like the National Payments Corporation's core infrastructure, would not just put the users into inconvenience, it would freeze the payment systems of the world's most populous country, and that is absolutely dangerous. And then there is external pressure. The dollar system does not disappear quietly. Sanctions don't require consensus, they require leverage. And the United States of America still holds most of it. Countries that have moved aggressively to bypass dollar infrastructure, Iran, Russia, Venezuela, have faced escalating financial pressure, not diminishing. India is not Iran or Russia, but it is not immune to the logic. India has built an exit, it has not built immunity. And India absolutely perfectly knows this. The NPCI has been expanding the redundancy. The government has been building cybersecurity frameworks. The Reserve Bank of India has also been stress testing the system for several decades. The gap between we know the risk and we have fully mitigated the risk is real, and it is something that we are currently working on but have not fully perfected. The question is not whether the system is perfect, right? It isn't, I'll be honest with you. The question is whether it is sufficient, and whether over time sufficient goes on to become dominant enough for India to achieve its interests. Here is what skepticals actually say, and they're not completely wrong about this. UPI is a domestic retail payment rail. SWIFT is an international wholesale clearing system. They don't compete. They operate in different layers at a very different financial stack. Comparing them is like comparing a road to a shipping lane. India still settles 85% of its international trade in dollars. The rupee is not a reserve currency and shows no sign of becoming one, right? And you observe the latest developments, you also see the gap between the rupee and the dollar just increasing significantly. Most of UPI's international corridors are small. Tourist payments, diaspora remittances, not oil contracts, not sovereign debt issuance, not the transactions that actually move the needle on dollar dependence. And for the talk of the de-dollarization, the dollar share of global reserves has barely moved in decades and still goes on to remain high, and the same. The skeptics are absolutely right about this today. The question is about direction. In 1990, nobody thought that Euro would exist within a decade. In 1995, nobody thought that China's economy would surpass Japan within 15 years. In 2005, nobody thought that a Finnish messaging app would become the primary communication tool for 2 billion people in a developing world. Structural financial change is slow until it isn't. What India has done is not a revolution, it is the creation of a viable alternative at a sovereign scale, one that works, one that is growing, one that has an increasing number of countries who are actually coming forward and choosing this for purely practical reasons. That is how infrastructure change happens, not through confrontation, through substitution. Here is actually the first principles read and the message. The current financial order resets on one foundational logic. The cost of building an alternative is higher than the cost of compliance. That logic had actually held strong for 80 long years because dollar infrastructure was genuinely more efficient than anything else that was available in the market, because access to the American capital markets was genuinely more valuable than independence from American oversight, because the system worked and working systems are almost hard and impossible to displace. India has not displaced that system. What it has done is change the cost calculation. Building a sovereign payment rail now costs less than it did. Operating one at a scale is proven possible. Exporting the architecture to willing nation has actually been demonstrated in the past couple of years. The exit door's construction cost, technically, diplomatically, and financially, is lower than it has ever been. Empires rarely end when they are defeated. They end when the world quietly builds systems that no longer need them. Britain did not lose its financial dominance in a war. It lost it when the dollar cleared trade more efficiently than sterling, when American capital markets were deeper than London's, when the world had a better option and started quietly uplifting that option and transitioning to that particular option. The rupee is not the dollar, UPI is not SWIFT, and India perfectly knows this, like I already mentioned. But India has built something that over 30 countries are actually using when I speak and when I'm making this video. Something that settles real transaction in real currency without touching American infrastructure. Something it is actively, deliberately, strategically exporting one bilateral corridor at a time. Whether this becomes the foundation of a new financial order or remains a sophisticated hedge by a country that remembers the 1991 is a question for the next 20 years. But the pipe exists, it is still carrying real money, and once the pipe exists, the leverage goes on to shift. Bikram's money arrived in Pokhran in 4 seconds. It cost nothing and it never touched a dollar.